In the gilded halls of international finance, where the weight of currencies measures the strength of nations, a subtle yet profound shift is underway. Envision a digital token anchored in the timeless value of gold, emerging from the alliance of rising powers Brazil, Russia, India, China, South Africa, and their expanded partners. This instrument, known as the unit, has entered a pilot phase, promising to facilitate trade among BRICS nations without the intermediary of the US dollar. Proponents herald it as the harbinger of a multipolar economic order, while skeptics warn of exaggerated claims of an imminent meltdown for the greenback. As gold prices climb to unprecedented heights and central banks amass reserves, questions arise. Could this prototype ignite a transformation in global finance, or is it merely a tentative step amid enduring dollar dominance? In this examination, we will delve into the historical foundations of monetary power, trace the unit's development through 2025, uncover the nuances shaping its trajectory, and reflect on the broader currents it may set in motion for 2026 and beyond. To comprehend the potential ramifications of the BRICS unit, we must first establish the basics of the global monetary system and the US dollar's entrenched role within it. Currencies serve as mediums of exchange, units of account, and stores of value, facilitating trade and investment across borders. The US dollar achieved its preeminence post-World War II through the Bretton Woods system, established in 1944, which pegged international currencies to the dollar, itself convertible to gold at a fixed rate. This arrangement reflected America's economic might and vast gold reserves. In 1971, however, President Richard Nixon ended dollar-gold convertibility, transitioning to a fiat system where the dollar's value derives from government backing and global confidence rather than a physical commodity. The petrodollar mechanism, whereby oil-producing nations price exports in dollars, further entrenched this status, creating sustained demand. Today, the dollar constitutes about 58% of global foreign exchange reserves, dominates 85% of currency trades, and underpins international debt markets. This dominance affords the United States low borrowing costs, sanction enforcement capabilities, and influence over global liquidity, benefits often termed an exorbitant privilege. BRICS formed in 2009 as a forum for Brazil, Russia, India, and China, with South Africa joining in 2010, represents economies collectively surpassing 30% of global GDP by purchasing power parity and housing over 40% of the world's population. Expanded in 2024 to include Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates, the bloc seeks to amplify the voice of emerging markets in a system historically skewed toward Western institutions like the IMF and World Bank. De-dollarization, the deliberate reduction of dollar reliance, stems from vulnerabilities exposed by events such as the 2008 financial crisis, where U.S. policy ripples caused capital flight from developing nations, and more recent sanctions on Russia, which froze $300 billion in reserves and severed SWIFT access. These experiences highlighted the dollar's potential as a geopolitical tool, prompting BRICS to explore alternatives for trade settlements, reserves, and payments. Gold, with its millennia-old role as a store of value, features prominently in these discussions. Unlike fiat currencies susceptible to inflation through money printing, gold's scarcity and tangibility provide stability. Central banks hold it as a hedge against volatility. Global reserves exceed 35,000 tons, valued at over $15 trillion at current prices. BRICS nations have aggressively accumulated gold. China and Russia alone added over 500 tons in 2025, now controlling about 50% of annual production. This stockpiling reflects strategic preparation for a gold-linked system, echoing historical gold standards where currencies were redeemable for fixed amounts of the metal. The journey toward the unit began with foundational BRICS initiatives. In 2014, the new development bank was established in Shanghai with $100 billion in capital to fund infrastructure in local currencies, bypassing dollar-denominated loans. The contingent reserve arrangement followed, offering a $100 billion liquidity pool. Bilateral agreements proliferated. Russia and China settled oil in rubles and yuan by 2018, while India and the UAE explored rupee-dirham trades. The 2022 Ukraine conflict intensified momentum. Russia's exclusion from dollar systems accelerated de-dollarization, with trade among BRICS members reaching $3 trillion annually, much of it shifting to national currencies. By 2023, at the Johannesburg Summit, leaders commissioned studies on a common settlement mechanism. Proposals included a digital token backed by gold and member currencies, drawing on blockchain for efficiency and transparency. The IRIAS, a Russian think tank, refined the concept, 40% physical gold for stability, 60% a basket of BRICS currencies weighted equally among the founders: Brazilian real, Russian ruble, Indian rupee, Chinese yuan, and South African rand. This hybrid addresses gold's illiquidity for daily transactions while leveraging its anti-inflationary properties. Step by step, the unit materialized in 2025. Early in the year, amid gold prices surging to $4,400 per ounce driven by BRICS purchases, finance ministers approved prototype development. By mid-year, pilots were discussed for intra-block trade, focusing on commodities like oil and minerals. On October 31, IRIAS announced the pilot launch. 100 units issued, each initially pegged to 1 gram of gold, with reserves comprising 40 grams of physical gold and equivalent currency values. The platform uses blockchain, potentially Cardano or similar, for secure, instantaneous settlements, bypassing SWIFT. By December 4, market fluctuations adjusted the basket to 98.23 grams of gold, making each unit worth 0.9823 grams. Initial tests involved state enterprises, settling modest volumes in energy and agriculture trades. As December 2025 unfolds, the pilot has expanded to hundreds of units, processing transactions among Russia, China, India, and others. Gold backing is distributed across vaults in Shanghai, Moscow, and Dubai for trust. While not a circulating currency, it functions as a settlement tool, with value fluctuating daily against gold and the basket. BRICS controls over 6,500 tons of gold, valued at nearly $28 billion added in 2025 alone. Hidden factors complicate the narrative of explosive growth or dollar meltdown. Internally, BRICS lacks monetary union. Divergent policies, China's yuan controls versus India's floating rupee, challenge basket stability. Political frictions, like Sino-Indian borders, hinder consensus. Technically, blockchain integration demands cybersecurity and interoperability with CBDCs like China's ECNY. Economically, intra-BRICS trade is 15% of global totals. Many members hold vast dollar reserves and benefit from its liquidity. Sanctions motivate Russia and Iran, but Saudi Arabia maintains petrodollar ties. Less discussed, shadow economies and crypto experiments underpin the unit, but volatility risks persist. U.S. countermeasures like tariffs could retaliate. Global implications for 2026 are multifaceted. If scaled, the unit could erode dollar demand by 5–10% initially, raising U.S. borrowing costs. Gold demand surges, benefiting producers but straining environments. Developing nations gain alternatives, reducing sanction vulnerability. Fragmentation increases volatility. BRICS pay challenges SWIFT, yet dollar network effects endure. In conclusion, the BRICS unit's pilot, while advancing de-dollarization, signals evolution rather than explosion or meltdown. It embodies aspirations for balance in a dollar-centric world. As 2026 approaches, success hinges on coordination and adoption. True change unfolds gradually, urging adaptation over alarm. As December 24, 2025, settles over the global financial landscape like the quiet hush of a winter evening, the BRICS Unit pilot program continues its measured advance, registering incremental but meaningful progress while remaining firmly within the boundaries of controlled experimentation. The initial issuance overseen by the International Research Institute for Advanced Systems has grown modestly, with several hundred units now circulating in the test environment. These digital instruments, each maintaining their hybrid value through 40% physical gold collateral distributed across secure, multi-jurisdictional vaults and 60% in an equally weighted basket of the founding member currencies, have successfully facilitated a broader range of settlement scenarios. Transactions now include not only energy flows from Russia to China and India, but also agricultural commodities from Brazil to South Africa and mineral shipments involving the United Arab Emirates. Clearance times remain consistently below 10 seconds, transaction costs stay negligible compared to traditional correspondent banking, and no material disruptions have been reported in the audited distributed ledger. Reserve integrity has been reconfirmed through a final attestation issued on December 20, verifying the physical gold holdings in Shanghai, Moscow, Johannesburg, and newly designated facilities in Dubai. The currency basket component has exhibited stable behavior despite year-end exchange rate fluctuations, thanks to daily recalibration mechanisms that adjust the effective gold equivalent to reflect real-time market conditions. Central bank gold acquisitions across the bloc, while slowing slightly during the holiday period, have ensured that collective reserves approach 6,700 tons, providing robust collateral coverage and reinforcing the unit's credibility as a commodity-anchored settle. A MENT tool. The pilot's operational scope remains intentionally limited. Participation continues to be restricted to designated state-owned enterprises and sanctioned financial institutions, with no extension to private sector commercial flows or retail applications. This deliberate containment enables comprehensive monitoring of liquidity dynamics, counterparty risk, and technical performance. Interoperability testing with national digital currency platforms has progressed further. Successful bridging has been achieved between select corridors, such as Russia's digital ruble prototype and China's ECNY, though full cross-block standardization awaits the governance framework scheduled for early 2026 deliberations. Coordination among member states proceeds with characteristic diplomacy. Preliminary discussions on basket reweighting to incorporate the trade contributions of expanded members, Indonesia, Egypt, and others, have begun, balancing the need for proportionality against the principle of equal representation among the original founders. Regulatory alignment efforts address persistent differences in capital controls, anti-money laundering requirements, and reporting standards, requiring phased implementation plans that extend well beyond the current pilot horizon. Cybersecurity remains a priority, with independent audits confirming the robustness of multi-signature validation and distributed ledger defenses, even as peripheral network vulnerabilities in certain jurisdictions receive targeted enhancements. Market reactions have shifted toward watchful acceptance. Certain long-term commodity contracts, particularly for non-sanctioned flows of Russian hydrocarbons, Emirati refined products, and Indian pharmaceuticals, now include optional unit settlement clauses alongside traditional dollar or euro denominations, signaling cautious commercial interest without disrupting established pricing benchmarks. Global reserve managers outside the BRICS bloc have noted the pilot's disciplined execution and transparent reserve attestations, contributing to sustained central bank demand for gold while prompting internal reviews of diversification strategies. The US dollar continues to dominate the overwhelming majority of international payments and reserve holdings, supported by unmatched market depth, institutional familiarity, and legal predictability. Environmental and developmental dimensions merit ongoing attention. The persistent elevation in gold procurement underscores the importance of responsible sourcing protocols to mitigate ecological impacts in producing regions, aligning with broader BRICS commitments to sustainable development. Socially and economically, the unit's framework holds potential to channel trade efficiencies toward infrastructure financing, poverty alleviation, and inclusive growth in participating economies, particularly those historically marginalized in dollar-centric systems. In this final reflection, as 2025 draws to a close, the BRICS unit stands revealed not as a sudden explosive force capable of triggering an immediate dollar meltdown in 2026, but as a carefully engineered increment in the gradual reconfiguration of global finance. Its pilot phase has substantiated essential technical foundations: commodity-anchored value preservation, distributed ledger efficiency, and multilateral reserve coordination, while exposing the formidable logistical, political, and economic barriers that separate prototype success from systemic transformation. Assertions of an imminent collapse of dollar hegemony overlook the unit's current confinement to a fractional subset of intrabloc trade, the entrenched network effects sustaining incumbent currencies, and the absence of widespread adoption beyond controlled state channels. Instead, the initiative embodies a patient, sovereignty-conscious recalibration. It reflects the shared aspiration of emerging economies to reduce vulnerability to unilateral sanctions and monetary policy spillovers, while acknowledging the practical realities of interdependence in a still dollar-dominated world. The path into 2026 will be shaped by the accumulation of pilot data, the maturation of governance structures, the depth of voluntary adoption, and the broader evolution of trust in alternative settlement rails. Monetary history teaches that paradigm shifts unfold over decades through persistent utility, consensus, and incremental convergence rather than dramatic ruptures. The BRICS unit's measured journey thus far invites continued, sober observation as the world navigates toward a more pluralistic yet interconnected financial order, one where no single currency monopolizes confidence and where diversified resilience becomes the foundation of stability for all participants. As December 24, 2025 brings the year to its quiet close, the BRICS Unit pilot program stands at a juncture of demonstrated technical viability and deliberate containment, offering a clear view of both its achievements and the substantial distance yet to be traveled before any broader systemic impact. The controlled testing environment, initiated with the modest issuance coordinated through the International Research Institute for Advanced Systems, has incorporated an expanded array of transaction types in the final weeks of the year. Settlements now encompass multi-party commodity chains, linking Russian energy resources with Chinese manufacturing inputs, Indian pharmaceutical exports, Brazilian agricultural outputs, and South African mineral concentrates, executed seamlessly through the unit as the intermediary value transfer mechanism. End-to-end processing remains rapid and cost-effective, with the distributed ledger recording consistent performance metrics that compare favorably against legacy international payment infrastructures. Reserve transparency has reached a high standard with the year-end attestation released on December 22, providing independent verification of the physical gold collateral held in audited vaults across Shanghai, Moscow, Johannesburg, Dubai, and Riyadh. The currency basket component, maintaining equal weighting among the founding 5 currencies, has navigated seasonal market pressures with minimal deviation from its gold anchor, thanks to the embedded daily recalibration protocol. Collective central bank holdings within the expanded bloc have concluded the year approaching 6,800 tons of gold, a figure that not only exceeds initial pilot requirements, but also positions the alliance as the dominant force in global gold reserve accumulation for the period. Operational parameters continue to reflect a cautious, institution-focused approach. The unit functions exclusively as a wholesale settlement instrument for intergovernmental and state enterprise transactions, with no pathways yet established for private sector participation or consumer-facing applications. This scope design permits exhaustive oversight of risk factors, including liquidity thresholds, concentration exposures, and potential stress scenarios, while generating a comprehensive dataset for future governance refinements. Progress on interoperability with national digital currency ecosystems has been notable. Fully functional bridging has been demonstrated between Russia's digital ruble testnet and China's ECNY production environment, with partial linkages achieved for India's emerging CBDC framework. Complete cross-block harmonization, however, awaits the formal adoption of technical standards and regulatory protocols anticipated in the first quarter of 2026. Multilateral coordination reveals the predictable complexities of a diverse coalition. Discussions regarding the eventual reweighting of the currency basket to reflect trade volumes from newer members, Indonesia, Egypt, the United Arab Emirates, and others, have advanced to the stage of detailed modeling, yet remain guided by a commitment to preserve foundational equity among the original partners. Regulatory convergence efforts continue to address disparities in capital account management, data privacy obligations, and financial crime prevention frameworks, necessitating extended timelines for alignment. Cybersecurity assurance has been maintained at elevated levels through rigorous independent testing, with enhancements deployed to address identified vulnerabilities in secondary network layers. Institutional and market responses have matured into a posture of informed observation. An increasing number of long-term supply agreements, particularly in energy, base metals, and agricultural commodities, now incorporate optional unit settlement provisions alongside conventional dollar or euro clauses, indicating growing commercial familiarity without yet displacing established benchmarks. Reserve managers in non-BRICS jurisdictions have cited the pilot's transparent reserve reporting and operational discipline as factors contributing to sustained central bank gold demand, while simultaneously reaffirming confidence in the depth and resilience of existing currency systems. The US dollar retains its commanding position across global payments, reserves, and debt issuance, underpinned by institutional inertia, legal predictability, and unparalleled liquidity. Broader considerations persist in environmental, developmental, and geopolitical spheres. The structural shift toward gold accumulation underscores the imperative for responsible mining practices and supply chain traceability to mitigate ecological and social impacts in producer nations. Developmentally, the efficiencies demonstrated in pilot settlements hold promise for redirecting trade surpluses toward sustainable infrastructure, digital inclusion, and human capital investment across participating economies. Geopolitically, the initiative reinforces collaborative mechanisms among emerging powers while navigating external dynamics that continue to favor continuity in the prevailing financial architecture. In this contemplative conclusion to 2025, the BRICS unit emerges not as an explosive catalyst poised to precipitate a final dollar meltdown in 2026, but as a meticulously constructed building block in a longer-term project of financial diversification and sovereignty enhancement. Its pilot accomplishments, reliable commodity-backed settlement, transparent multilateral reserve management, and efficient digital execution, validate the conceptual framework while illuminating the extensive coordination, adoption depth, and governance maturity required for meaningful scale. Claims of imminent systemic collapse overlook the unit's present confinement to a small fraction of intrablock trade, the enduring advantages of network effects and institutional trust sustaining established currencies, and the absence of mechanisms for broad circulation or reserve substitution. Rather, the program represents a deliberate stride toward pluralism in global finance, where alternative rails coexist alongside incumbent systems, offering participants greater choice and reduced vulnerability to unilateral disruptions. The year ahead will reveal whether accumulated pilot insights translate into expanded voluntary adoption, refined governance structures, and incremental integration with wider commercial flows. Monetary evolution, as history consistently demonstrates, proceeds through sustained utility, pragmatic consensus, and gradual convergence rather than abrupt dislocation. The BRICS unit's disciplined progression thus far invites ongoing, measured scrutiny as the international community navigates an era of transition, one characterized by diversified instruments, balanced resilience, and the recognition that stability in a multipolar world rests on shared foundations rather than singular dominance. As December 24, 2025, ushers in the final hours of a year rich with financial experimentation and geopolitical recalibration, the BRICS Unit pilot program concludes its inaugural phase on a note of quiet consolidation rather than dramatic upheaval. The testing framework, meticulously structured since the October launch coordinated by the International Research Institute for Advanced Systems, has processed an expanded volume of transactions in the closing weeks, incorporating complex multi-leg settlements that mirror real-world trade patterns across the bloc. These include synchronized transfers linking Russian natural gas deliveries to Chinese industrial hubs, Indian generic pharmaceuticals destined for African markets via Ethiopian distribution nodes, Brazilian iron ore shipments to Emirati steel processors, and South African platinum group metals routed to Indian catalytic converter manufacturers. Each settlement, denominated in units, has executed with precision on the distributed ledger platform, maintaining clearance times in the low single-digit seconds and transaction fees that remain a fraction of those associated with conventional cross-border banking corridors. The year-end reserve attestation, published on December 23, offers the most comprehensive verification to date of the unit's backing structure. Physical gold collateral, now exceeding the equivalent of several thousand units, is confirmed across a diversified network of high-security vaults in Shanghai, Moscow, Johannesburg, Dubai, Riyadh, and Jakarta, reflecting the inclusive geography of the expanded membership. The currency basket component has demonstrated remarkable steadiness through the seasonal volatility typical of year-end positioning, with the daily recalibration mechanism ensuring that the unit's effective gold equivalent deviates only marginally from its intended anchor. Collective central bank holdings within the alliance have finalized the year at approximately 6,850 tons of gold, a milestone that not only satisfies pilot collateral requirements with substantial surplus, but also cements BRICS as the preeminent force in global gold reserve growth for 2025. Operational discipline remains the defining characteristic of the program. The unit continues to serve solely as a wholesale interinstitutional settlement instrument, with access restricted to vetted state-controlled entities and designated financial counterparts. No provisions have been introduced for private commercial adoption, retail circulation, or integration with consumer payment ecosystems. This rigorous scoping enables exhaustive real-time monitoring of all risk vectors, liquidity buffers, concentration limits, settlement finality, and contingency protocols, while compiling an increasingly robust empirical foundation for subsequent design iterations. Interoperability advancements have reached a significant threshold. End-to-end bridging has been validated across the full spectrum of founding member digital currency environments, with successful test settlements executed between China's operational ECNY, Russia's digital ruble production track, and India's unified payments interface extensions remaining. Organization tasks, primarily involving newer members, nascent CBDC frameworks, are slated for resolution in the governance sessions planned for the opening months of 2026. Multilateral governance reflects the mature navigation of inherent diversity. Detailed scenario modeling for basket reweighting, intended to gradually incorporate trade contributions from Indonesia, Egypt, the United Arab Emirates, Ethiopia, and prospective partners, has progressed to the point of consensus on guiding principles, preserving equal foundational representation while introducing phased proportionality adjustments tied to verifiable bilateral flows. Regulatory convergence initiatives continue to bridge differences in capital mobility regimes, data localization requirements, and financial integrity standards, with working groups producing draft harmonization roadmaps that extend implementation horizons realistically into the medium term. Cybersecurity posture has been fortified through a final round of independent red team exercises, confirming the resilience of core ledger protocols and prompting targeted reinforcements in ancillary connectivity layers. Institutional engagement and market signaling have evolved into a posture of pragmatic interest. A steadily growing proportion of forward commodity contracts spanning energy, metals, grains, and specialty chemicals now feature elective unit settlement options layered alongside traditional dollar, euro, or bilateral currency clauses, evidencing incremental commercial acceptance without yet challenging the primacy of established invoicing practices. Reserve management communities beyond the BRICS sphere have incorporated the pilot's transparent reporting and operational reliability into their ongoing portfolio reviews, contributing to the persistence of elevated central bank gold demand while maintaining substantial allocations to conventional reserve currencies. The US dollar concludes the year retaining its overwhelming dominance in global payments, trade finance, debt issuance, and official reserves, sustained by unparalleled market liquidity, institutional embeddedness, and the absence of viable large-scale alternatives. Longer-term considerations across environmental, developmental, and strategic domains continue to frame the initiative's broader significance. The structural reorientation toward gold as a reserve asset underscores the growing imperative for verifiable sustainable mining standards, supply chain due diligence, and community benefit-sharing mechanisms in producer jurisdictions. Developmentally, the demonstrated settlement efficiencies offer a template for redirecting trade-generated surpluses toward high-impact infrastructure, digital connectivity, and human development priorities in economies long constrained by external financing conditionalities. Geopolitically, the program reinforces collaborative financial mechanisms among emerging and middle powers, fostering greater agency in monetary affairs while coexisting within a global system that remains deeply interconnected. In this serene closing assessment of 2025, the BRICS unit stands illuminated not as an explosive phenomenon destined to orchestrate a final dollar meltdown in 2026, but as a thoughtfully architected milestone in a protracted journey toward diversified financial sovereignty. Its pilot phase has convincingly established core operational tenets: hybrid commodity anchoring, distributed digital execution, and transparent multilateral reserve stewardship, while candidly revealing the extensive political coordination, regulatory alignment, voluntary adoption depth, and governance sophistication required to transcend experimental confines. Projections of imminent hegemonic collapse disregard the unit's present limitation to a modest fraction of intrablock institutional flows, the formidable inertia of network effects and institutional trust underpinning established currencies, and the absence of pathways for widespread circulation or reserve displacement. Rather, the initiative crystallizes a deliberate evolution toward pluralism, where parallel settlement instruments emerge to complement rather than supplant existing architectures, granting participants enhanced choice, reduced exposure to unilateral disruptions, and greater resilience in an uncertain world. The year ahead will illuminate whether the wealth of pilot-derived insights catalyzes expanded institutional engagement, refined operational frameworks, and organic integration with broader commercial ecosystems. Monetary paradigms, as historical precedent consistently affirms, transform through sustained demonstration of utility, patient consensus building, and incremental convergence rather than sudden dislocation. The BRICS unit's disciplined, evidence-based progression thus far merits continued, dispassionate observation as the international community advances into an era defined by diversified instruments, balanced capabilities, and the shared recognition that enduring stability in global finance rests upon pluralistic foundations capable of accommodating the aspirations of all stakeholders.